Hi everyone, thank you for tuning in to another recording on FINA1221 Introduction to Finance. In this video recording, I will go through the remaining slides of Week 5 lecture on interest rate. We start with a quick recap on what we covered on Monday. We learned that there are different ways to express interest rate. More specifically, as market participants prefer communicating in the unit of a year, there are two ways to express annual interest rate: EAR, effective annual rate, and APR, annual percentage rate. We went through how to convert from EAR to periodic interest rate and from periodic interest rate to APR, but more typically in a practical scenario, you will be given an APR and your task is to figure out how to find a periodic interest rate that matches with the frequency of your cash flows. If you have a monthly cash flow, then you will need a monthly interest rate. Similarly, if you make a payment every quarter, then a quarterly interest rate is needed. Let's go to slide 24. We also established that in real life, when you deposit money in banks, interest rates quoted by the banks do not actually tell you how much money you will have in terms of purchasing power. It tells you that nominally, your saving will grow by R%, but this doesn't mean you will be able to buy R% more of the same products comparing to today. We call this type of interest rate nominal interest rate. We also introduced the inflation rate as a term to measure the growth of prices of goods. Therefore, we can measure the growth in purchasing power. As the formula that's seen over here. And this RR here is known as the real interest rate. Alright, now when we talk about cash flows to be occur in the future, we can either specify it in its nominal term, which is simply its dollar amount, or the real term, which is inflation adjusted that expressed in today's dollar term, or equivalently in today's purchasing power term. We have nominal cash flow, real cash flows, nominal interest rate, and real interest rate. When do we use what interest rate to discount a certain type of cash flows? It's quite straightforward. When we express cash flows in real term, we use real interest rate to calculate present value. When we express cash flows in nominal term, we use nominal interest rate. We discussed this example on Monday, so now let's move on to another example in the next slide. Now suppose we are estimating the present value of a 20-year annuity that the first payment in 1 year's time is $10. It is expected to grow with inflation. The relevant nominal interest rate is 12%, with inflation expected to be 5%, that both expressed per year. So the first payment is $10 in 1 year term. The second payment will be $10 times 1.05 in 2 years term. There are two ways to solve this question. We can establish a timeline with nominal cash flows and discount them by nominal interest rate to calculate the present value, or using real cash flows with real interest rate. So here I made two timelines to illustrate and to make your life easier. The first of all, we start with nominal cash flows. So here we have a 20-year annuity, go from year 1, 2, and all the way to 20. We know that the first payment is going to be $10. And this is expected to grow with inflation such that the next one will be $10 times 1 plus the inflation. And the next one will be $10 times 1.05 square. So the last cash flows will be $10 times 1.05 power to 19. So using the knowledge that we had from week 4, we recognize this is an annuity with constant growth. So this is one way to solve it, to solve the present value, just using the annuity with constant growth formula. And here the interest rate, given this is nominal cash flows, we'll use nominal interest rate, which is 12%. But equivalently, you can also think about this in a real term. So the first cash flow in 1 year, it will be in 1 year's time, which is $10. So if we use that to measure what would be in today's term, So we have to deflate it such that, well, we know that the price of the goods would go up by 5%. So $10, if we're trying to measure using today's purchasing power, that will be $10 divided by 1.05. So 1 plus inflation rate. How about next year? Well, in year 2, the nominal term will go up by 5% because it's inflation adjusted. So that will be $10 times 1.05. But what about in real term? Well, you have been inflated for 2 years, so that to adjust it for today's term, that would need to be divided by 1 plus the inflation rate power to 2. So that if you simplify it, that would be $10 divided by 1.05, which is the same as the first year. And if you keep going, say all the way to year 20, and the nominal cash flow will go up to $10 times 1.05 power to 19. But because it's been 20 years, to adjust it for inflation, or well, to really deflate it, you need to divide that term by 1.05 power to 20, such that in the simple form, that will still going to be $10 divided by 1.05. So you can see that now we're having an annuity because the cash flow is the same every year. So that would be your real cash flows. But what interest rate should we use? Well, we need to discount real cash flows using real interest rate. So the next 2 slides will show you the answer. So we start with using the nominal cash flow divided by the nominal interest rate. So over here, we recognize that was a growing annuity. So plug everything in. The cash flow is $10. That's the first cash flow. If you come back here, that is the first cash flow is $10. So that's in the formula, that's always the first cash flow, right? So $10 and the R is 12%. The growth rate is the inflation, which is 5%. And the N here is 20. So the present value is $103.56. We can also do the same question using real over real. So we recognize that was an annuity, so we know that here is the formula that we should use. But the real cash flow, as I showed you in the previous slides, the cash flow will be $10 divided by 1.05 to be deflated. Because, just want to say again, because that $10 is the cash flow that you will receive in 1 year's time. Which means if you transform it back to today's purchasing power, that has to be deflated. So which means it needs to be divided by 1.05. So in this case, the N is 20, the C is 10 over 1.05. But how about the interest rate? So here we need to use the real discount rate, which is using the formula that you see over here. I think on this slide, you can see that that's the formula you need to use. Nominal interest rate minus inflation rate, bracket, divided by 1 plus inflation. Which is what we do over here. So you can work out the interest rate is 6.67%. You get the same answer, 103.56, right? So it doesn't matter whether you prefer real or nominal over nominal, you should arrive at the same answer. So we come to the final part, which is yield curve opportunity cost of capital. One thing we mentioned at the start of Monday lecture about the inverted yield curve in US seen on last Friday, which caused a market turmoil in Asian markets on Monday morning. To understand what the discussion was about, we firstly need to know what is a yield curve. Here is the last complication about interest rates when we're trying to get closer to the settings in reality. The interest rates can vary depending on the investment horizon. Let's say if you go to the bank and say you want to make a term deposit, what would typically happen is that they will offer you a different interest rate depending on how long you would like to deposit for. For example, they may give you 3% per year if you are putting your money down for 1 year, or 3.5% per year if you are putting down for 3 years. The high interest rate per year for a longer term acts as an incentive for you to be willing to lock up your money with them for a longer period. So why would they want that? Why would a bank want that? Well, think about this. A term deposit is a saving plan that the customer cannot withdraw money out from the bank until the end of the term. The longer the lockout period, the more flexibility the bank would have to use the money that you give to them for investment. After all, the bank typically profits from the difference between how they obtain money through people's saving and how much extra they can charge when they lend money out to customers. So here we have two new terminologies. The first one is term structure, which is the relationship between the investment term and the interest rate. And the yield curve is a graph of the term structure. So here is an example of term structure of risk-free Australian interest rate in September 2000, 2004, 2008, 2012, and 2016. So here we have 5 different colors, and that illustrate 5 different years. So in each year, say for example, let's take 2016, the bottom line over here. You can see that. So here is on the x-axis, this is a term, so which means if you put money in for 2 years, you roughly get about 1.6% per year. In comparison, if you put money in the bank for say 10 years, that will get you about 1.8% per year. And that varies across, different years. So you can say that on average, well, put money in the bank would get you less interest than a typical saving plan in say 2000. So how would you then calculate the present value if interest rates are not constant anymore? That is, interest rate differs across investment horizons. That means we can no longer use the present value of annuity formula, even if all cash flows are the same every year. So you could have the same seed, but because the interest rate is different, you have to use this summation of the present value formula. So we're back to using this sort of long formula, summation of individual present values. And let's just illustrate that using an example. So in this example, let's compute the present value of a risk-free 5-year annuity of $1,000 per year. So each cash flow is $1,000. And the yield curve shows here you have 5 different terms, which means if you put money in the bank for 1 year, you would get 1% per year. A 2-year rate shows you if you put money in the bank, you would get, for 2 years, you would get 1.2% per year for 2 years. Not 1.2% for the whole 2-year period, but it's 1.2% per year for the 2-year period. Remember how we in finance we always trying to talk about everything in annual term, and that is how the rate is specified. So here that would be 1.8% per year for every year over the 3-year period, and same thing goes for 5-year rate. 1.5% means 1.5% per year for 5 years. So which means in this case, you can no longer use the present value of annuity formula, but rather you have to use this long summation such that the first $1,000 will be discounted using the 1-year rate, because that will only need to be with the bank for 1 year, and the second 1,000 will be 1,000 divided by 1 plus the 2-year rate power to 2, because that will be using the 2-year rate, because that money will be staying in the bank for 2 years. Same thing over there, 3 years, 4 years, and 5 years. And sorry for that email. I should have turned on my email alert. Alright, so here you can see that that just means you need to use a different interest rate for a different term. The cash flow in first year using the interest rate for 1 year. Cash flow in 4 years time will be using the interest rate for 4 years. You can see the calculation isn't that difficult. You will get an answer of $4,788.58. It's just a bit more tedious, and you need to know which interest rate you're going to be using. So the yield curve tells us the market interest rate per year for each different maturity. And in order to calculate the present value of cash flows, we need to use 5 different interest rates corresponding to those maturity, so we can no longer use the annuity formula here because the discount rates differ for each cash flow. And of course, yield curve can take different shapes. So in this figure, we illustrate 3 different scenarios. The blue line on the left panel represent a normal yield curve, which is going upward, and most of the time the yield curve has this shape, right? It's upward sloping. The red line depicts a steep yield curve, which means the jump from, say, putting money for 1 year to say put money in 5 years will be a lot larger than in this normal case. And finally, on the very right hand side, the green line depicts an inverted yield curve. It's called this because it slopes downward instead of upwards. And how does that happen? I mean, what does that represent? It shows you that the interest rates are higher per year than if you put money in the longer term. Which is quite strange because we talked about it earlier that the bank trying to give you a high interest rate to encourage you to save money with them for a longer time. But then why would they trying to do this? I mean, what happened in this inverted yield curve scenario? Well, in this case, you can think about, well, the bank doesn't want you to save money with them for a longer period because they may have no idea where to invest because there's so many uncertainties in the economy, right? So you can read about it, you can just please Google or Wikipedia the inverted yield curve term and see there's a whole bunch of discussion along that line. So what determines the interest rate? Well, so here, what that yield curve tells us that if interest rates are expected to rise, longer term interest rate would tend to be higher. So then short-term interest rate to attract investors, and if they expect it to fall and there are a lot more uncertainties, longer term rate would tend to be lower than short-term rates to attract borrowers. So here, then that's what we call steep, which is the one in the middle, inverted, which is the one on the right. Normal, steep, and inverted. And now let's take a look at this another figure to show you what we can learn from the difference. Which means when we talk about the inverted yield curve on Monday, we meant that it was a 10-year government bond rate minus the 90-day bank bill rate, which is the green line, minus the red line over here, became negative, right? Which means that red line it will be on top of green line because that is the magnitude illustrated on the y-axis. And this is in Australia, and what happened on Monday was what we're seeing in US, that we saw an inverted yield curve. So I guess one thing that people sort of like take a notice is this line over here, that the blue bars, blue bars shows the periods of Australian recessions as determined by the ABS. Note that the inverted yield curves over here, like the one that's shaded in red, because it's the red line, 90-day bank bill rate, is exceeded the 10-year government bond rate. So the inverted yield curves tend to precede recessions. See how here I have the inverted yield curve, or negative interest rate, which is 10-year minus 90-day is negative. That will precede recession. See, recessions over here, and that would then lead to a recession over here and here, and this region also leads to a recession here, and this region leads to a recession over here. But I guess, don't get too excited about this diagram, because is this a perfect prediction? If you look at the figure closely, the red region doesn't tell you exactly when the next recession is. It could be next year, it could be in 3 years' time, it could be you're right in the middle of it. And more importantly, it doesn't predict how long the recession will be. So don't overinterpret the inverted yield curve. It's just is what it is, and that it doesn't really tell you what people already know. It doesn't really tell you more beyond what people already know. In the next two slides, we'll illustrate the impact of interest rate changes to the present value across different investment horizons. The basic idea of this example, which you should read it yourself, is that for the longer term, an change in interest rate would have higher impact to a longer term. So, pause the video, read the example, and you will see that a change in interest rate from 11% to 10% will be huge for the 30-year loan, which is it changed the value by 24% compared to only 0.9%. So then what that example trying to tell you is that you can see why investors and banks view longer-term loans as being riskier than short-term loans. Alright, now we are to the very last topic of today. The opportunity cost of capital. So opportunity cost of capital is really pretty much like an economic concept that you would hear a lot from in an economic unit. So it measures the best available expected return offered in the market on an investment of comparable risk and term to the cash flow being discounted. So here let's use an example. Suppose your friend offers to borrow $100 from you today and in return pay you $110 1 year from today. And let's just say, what would you do? Well, you look into the market to think about what would be the best use of your money if you didn't lend it to him. And you find that the best alternative option is to think about, well, I'm going to find an investment that is as risky as lending it to a friend, and that investment happen to have a return of 8%. So in this case, you can think about, well, if I don't lend it to my friend, I invest in a similar risky project, I would have got 100 times 1.08, which is $108 after 1 year. But then if I lend my money to the bank, I will get 110, right? Which is what I discussed over here. So which means which is better off if you lend money to a friend, you get $110 compared to if you lend money to, or if you do this investment elsewhere, that will be only $108. So which means it is better off, right? So the valuation principle tells us that we can determine the value of an investment by using market prices to value the benefit net the cost, because the market prices tells us what would be the best alternative opportunities are, so that we can decide whether an investment is worth the cost. We'll come back to this opportunity cost of capital topic in week 9 when we're talking about capital budgeting. And that's it. Thank you. Remember, your third test is due this Friday, and next week we're going to talk about valuing debt instruments. See you on Monday.